Alright, hey traders, Julian Marchese here. Today is July 16th, 2012, and in this video I'm going to give you guys a market update on my positions and my biases, and I'm also going to have a little focus on this video in really intermarket themes. I did a post before, I believe, on my blog. I think if you check back you'll find it on marchesefinancial.com. I put a link. I made a post exemplifying the divergences we've been seeing between, for example, the S&P, the U.S. stock market, and various other markets around the globe, and that be including equity, commodities, etc. And obviously, if we take a look at the S&P, say versus oil, let's bring a chart up of oil here. You can see oil has definitely underperformed the S&P, and then obviously if we bring up uh, the euro here, we've been underperforming in the euro as well, given Europe's, debt troubles right now. Uh, really nothing to explain there why we're seeing more selling in the euro. But so we're seeing continued outperformance in the S&P. We're basically where we were 3 months ago in the S&P, and where when we compare it to say oil, look how much lower we are, and then once again take a look at the euro, just much lower than we were 3 months ago. So basically what this tells me is the theme we have in the global markets right now is that Europe obviously is, no one wants to touch Europe. People don't want to put their money into risky assets. We have to think, what are the market participants, where do they want to put their money? Because they're looking for some sort of yield. They're looking to put their money, especially in a global environment like today, where there's so many risks to the financial system. Investors want to put their money into something that can hopefully yield them something, yet not pose significant risk. So Europe is out of the question right now in terms of equity. And that even includes Germany, the UK, even with their easing policies. Let me see if I could bring up a chart of the UK. I believe it's this EEI. Yeah, this is the FTSE 100. You can see it also showing underperformance, although last year was pretty stagnant. So yes, once again, no one wants to touch Europe. In Asia, China is currently going through a slowdown, so that's affecting most of the Asian economies. So we're seeing selling in, Hong Kong. Hong Kong's underperforming, China's underperforming, obviously. So people don't want to put their money into emerging markets as well, especially in this environment. Only if investors are really seeking risk. So what I'm talking about is in general, as you're looking to invest in a developed economy and a relatively safe investment. So once again, Europe, Asia, out of the question. So the only real place left is the United States, if we're discounting, smaller countries like Canada. Canada also has its risks to the commodity sector. Canada's heavily weighted in oil and gold, so it's been underperforming as well. Back to the S&P. So investors want to put their money into the U.S. and they really have a couple of choices. They can put their money into treasuries, which is basically yielding negative real rates. So the 10-year, let's bring up the 10-year right now, is yielding 1.4, and inflation takes that to negative. So treasuries, the only reason to really purchase treasuries here is just to participate in the flow into treasuries. Treasuries, although they're negative yielding, it's better to put your money there in a safe asset and potentially gain either through if you're betting on deflation coming into play in the next couple of years, or if you're playing on the rally higher in bonds, you can make up your negative yield there. But so you could put your money into treasuries, that's obviously the safest option. Or you could put your money into equity. and that's basically what's been happening. The only real areas that I can see personally where investors and market participants are putting into their money, and it's obviously helpful to know this as a trader, because as traders we want to know which markets are good to short, which markets are good to be buying. So it's important to look at the longer term picture and the longer term flows of money, basically, to give ourselves a picture and a direction as to where we should be trading in the shorter to medium term. So investors have to put their money into, stock. If they want to put any risk on, they go through the stock market. And obviously this is why utilities have been just outperforming like crazy, because investors still recognize that the U.S. Is still prone to risks or spillover from Europe and Asia. So we're seeing money flow into utilities, also into discretionary and to staples, especially consumer staples, especially, which is also a recessionary proof sector. I think Walmart's a great chart to look at for the theme in the U.S. market right now. This is what investors are putting their money into. They want some sort of yield. They want to gain somewhere, but they don't want any risk, or any significant risk. And the best way to do that is defensive sectors in the U.S., because the U.S. is the safest developed economy right now. And you want some risk. But you don't want too much, so you put into a defensive sector in the U.S. Another way to do it, which is an article, I actually did an article on this on Seeking Alpha today. It got published today. I'll link it into the YouTube info box if you click the links below. Investors are putting their money into high yield. So high yield corporates, these are corporates that are not investment grade. But these are the bonds of, say, riskier companies. And this investing in high yield is less risky than equity, but obviously more risky than treasuries. So it's kind of a happy medium. And high yield, obviously this chart is not counting in the yield and the dividend payments, but we're basically at all-time highs. We've gained a large percentage, I believe. Back in 2010, the ETF, this is dividend adjusted, was at 70 or so, and is now at 90, 91. So it's been a good return lately. It offers a 7% dividend yield. So high yield may be an interesting sector to play the next time we have a sharp drop in either equities, in global equity markets and risk markets in general. And typically high yield has the personality where when it drops very sharply, like extremely sharply. You could see it on the charts, August, how quick the move down was, but it rebounds, almost instantaneously afterwards and back to its happy medium at around 90, or it has been for the last 2 years. So that's the theme of the markets right now, The United States is right now the best place to put their money, or at least that's what investors are looking at. They're looking at putting their money into equity and treasuries in the U.S. And I think that theme's going to continue, and that's why we're going to continue to see outperformance in the S&P. That being said, I am short the S&P. I am short the S&P right now. I'm also short oil, and I'm also short euros. And I continue to hold a base position into bonds. Once again, I am participating in this bond rally like any other investor right now. And it's really based off of this one theme. There's not much to understand behind it. It's just that investors need to put their money somewhere. And treasuries will continue to be that place whenever equities pull back. And even when equities are rallying, if the current environment stays in this global economy, treasuries will continue to rally. So I remain long bonds. I'm short commodities like oil, copper, steel. United States steel is a good way to do that. or if you want to go through stock for copper, you could go Freeport McMoran. I am long gold, but lightly. I would have preferred to have a short position, but gold isn't really acting as I would like it to, because I do think gold is going to, let me bring up the futures contract so we can have exact prices. Here's some lines. You can see the technical picture on gold is bearish. And I think because we aren't seeing any accommodative policies, or at least we didn't see any hint of QE3, I was expecting gold to fall harder on that, but we didn't really see a fall. We had a rally with equity markets, and gold right now is playing like risk. So whenever Europe is really the center of attention, I made this point a couple days ago on Twitter. Whenever Europe is the center of attention, we tend to see gold act like a risk market. So I'll give you an example. This is the euro versus gold. Should I do it the other way around? Yeah. This is gold versus the euro. And you can see, sorry, not gold versus euro, we want gold versus S&P. You can see that gold outperforms the S&P when the United States is the center of attention. Okay, so whenever this spread blows out, that is when when gold is outperforming relative to the S&P, and you only see these major moves in this pair when the U.S. is the center of attention. So the three instances we have here are the October crash of '08. Obviously, that was U.S. centered. Now, the 2010 May rally we had here, you could argue that was Europe, but I think it also has part to do with the flash crash that did have some implications. But that's a minor one, so let's not even count that. And then the last major rally we had was in August, which was the downgrade, so that was United States centered. You can see when Europe is in play, gold doesn't outperform, and that's because the euro is being sold off, the dollar is being bought, and gold will underperform in that scenario. However, when it's a United States centered, say move lower on risk assets, the US dollar won't rise as much, or it will become stagnant like we had in August, or it will even rise, and that will, or it'll even drop, and that will cause gold to really outperform as it turns back into a safe haven, and treasuries go even lower the yields on them, so the only real place is to put into gold. So I'm long this pair essentially, long gold, short SPY, especially going into the debt ceiling debates and fiscal cliff. I think we're going to see fiscal stimulus as monetary policy continues to see diminishing returns. As yields get lower on treasuries, the harder it is for the Federal Reserve to have any impact, especially through unconventional means like QE. So that's what I'm looking at in markets right now. Basically, short risk, long gold, and bonds. I think that's the trade right now, especially going into fiscal cliff. All right. Have a great trading day, guys.